Okay, so this is a exam chapter 21 problem, and this is probably a really good problem that we would see on an exam. So let's go through this and see if we can figure this out. So we have a company named Johnson, and this is also on the PDF file that I sent you with sort of an explanation of everything, but thought you'd get an audio version maybe to help you with the learning aspect of it. But we have Johnson Inc. leased equipment from Broadway Company under a 5-year lease, requiring equal annual payments of $360,000. With the first payment due at lease inception, the lease does not transfer ownership, nor is there a bargain purchase option. And the equipment has a 5-year useful life and no salvage value. So Johnson then would have an incremental borrowing rate of 12%, and the rate implicit in the lease, which is known by Johnson, is 10%. So we have this big sort of problem that we have to figure out how to treat it on our leasing terms. Is this an option? Is this an operating lease, or is this a capital lease? So that's sort of the first question we would ask ourselves. And the question would be, with the capital lease that we have, is we know that under the terms of a capital lease, we have what we call, and I'm going to put that up here, title transfer, BPO, which is our bargain purchase option. Well, right in the question, it says immediately that there isn't a title transfer, nor is there a bargain purchase option. So the next question would be our classification of this 75% and then the 90%. And 75% would be the economic life or the useful life of the equipment. Does the lease equal or is greater than the economic life of the equipment? Well, we know that our term of the lease is 5 years, and the useful life is also 5 years. So if we divide that by 2, that's going to equal 100%, or 1, and so therefore it qualifies as a capital lease by meeting just this one requirement. We don't have to ask ourselves about the 90% fair value of the asset. So we can just move on. So we know that it's a capital lease. The second question comes into play is this considered an annuity or an annuity due factor? Which table do we use? So I'm going to put that here. This is a sort of our table, and we might have a choice that we say, okay, is this considered 12%, 10%? Is this an annuity due? Is this an ordinary annuity? So the answer sort of is given in the question because it says right here, with the first payment due at lease inception. So anytime you see when a payment is due right when the lease is signed, which is at inception, you will see that in that case, it's considered an annuity due. A payment is due right up front. And so that reduces overall the interest is earned by the lessor because we're paying less principal as a result. So if we look at that, we know that it's an annuity due factor. Okay, so we know that in this case it's going to be somewhere in this area right here. Okay, so we know it's going to be somewhere right around in annuity. The question is it the 10% or 12%? Well, we know by FASB rule, that any time the incremental borrowing rate and the implicit rate are given, and the implicit rate is lower than the incremental borrowing rate, which in this case it is, and it is also known by the person leasing the equipment, which is Johnson in this case, and it is known. So therefore, because it's known by Johnson and the implicit rate is lower, we're going to go ahead and use the implicit rate, if I can draw here. And I'm going to erase that because that looks bad. And oh gosh, let's undo this. There we go. So I'm going to go ahead and record that at the 10%. I'll tell you what, this is what I'm going to do. We're going to say 10%. And we're going to say 5 years. Okay, so that's what we're going to do. So we know we use an annuity due factor. We know it's a capital lease. We know the borrowing rate is 10%. And so now we can sort of create this scenario where we can answer problems. What is a question that maybe we would want to ask in a problem? Well, the first question might be, what amount do we record the lease at lease inception? So that is very simple. We just take the $360,000. And we know that we're using the annuity due factor of 10%, which is the 4.1699, and that's going to give me $1,400,000 $501,000 and I believe $164. Okay, so we know that when we record the lease on our books, it's going to show an asset of 1.5 million and a lease liability of 1.5 million of that amount. Okay, so we know that's for sure. Then the second question might be, well, what do we record the first year? The interest expense for the first year. Well, that might be a little bit tricky because we have to remember that we have an annuity due, and so we paid the first payment initially. So we're going to take this 1.501164, and the very first thing we do at the inception is we have to reduce this $360,000 out of it. Okay, because we don't pay any interest on that $360,000 because it's due right away. That leaves us with a balance of $1,141,164. Okay, so that's the remaining amount of the lease on the very first day. So then from there, what we can do is take the $1,141,164, and then we basically take 10% of this, right? Because that's our factor that we're using, or our interest rate that we're using, and that's going to give me $114,116.40. Okay, so the very first year of interest that I'm going to incur at December 31st, 2000 of the first year of 01, I should say, is going to be $114,116.40. Finally, the question could be, well, what would happen if we were to have to pay interest in the third year? How much of that interest would we have to pay? What about the fourth year? Would there be interest? So what ends up happening is we have to create some sort of table. So in the problem, I've given you this table that sort of gives you an amount of what it would be. So in this case, we can see that the first year, there obviously is $114,116 that we had set. The second year, we reduce this down because we're taking $895,280, multiplying that by 10%, and that's our interest. So the remaining amount becomes the principal. Remember, we're always paying $360,000 for every payment. But part of that is interest, and part of that's a reduction on the liability. There is no executory cost in this case, which is like maybe there's some costs to sign the lease, maybe there's a broker involved or whatever. So we wouldn't have that in this particular problem. If there was, in such a case, a problem where we would have executory costs, we would have to subtract that out from the lease payment. Then we multiply the remaining amount by the interest factor and so forth. Okay, so that last $18.20 is just a rounding error, no big deal. But so hopefully that gives you an idea of how to work a problem like this when it comes to whether it's an operating lease or a capital lease. Now, if it was an operating lease, all we would just simply do is, in this case, we would have a lease expense of $360,000. And then we would credit just simply cash of $360,000. Okay? So if that was the operating lease, well, in that case, that's how we would work that. So it would be very simple in that case if it was operating. But we said by the qualifications of title transfer, BPO, bargain purchase option, 75% or 90, we meet one of those criteria, and so therefore we have to consider it a capital lease. Okay?